Welcome back to the deep dive. Today, we are opening up a file that it really sits right at the intersection of logistics, artificial intelligence, and what I frankly think is one of the most absurd habits of modern society.
You're starting strong. What habit is that?
I call it the burrito
The
paradox.
burrito paradox. Okay, I'm listening.
Okay, picture this scenario. It happens, millions of times a day. You're sitting at your desk, you're hungry, you want a burrito. That burrito weighs, what, maybe 2 pounds?
If it's a good one, maybe a pound and a half.
Yeah.
But sure, let's say 2 pounds. Yeah.
So you tap a button on your phone, and to get that 2 pound cylinder of beans and cheese from the restaurant to your front door, we dispatch a 2-ton vehicle.
A 4,000-pound machine.
A 4,000-pound machine, driven by a human being, burning fossil fuels, taking up a parking space, adding to traffic congestion. We're mobilizing 2 tons of steel and plastic to move 2 pounds of lunch.
From a physics standpoint, it's just insane.
It's insanely inefficient.
It is the definition of absurdity. And, when you actually crunch the numbers on the externalities of that system, it gets dark pretty fast. You're talking about a logistics model where U.S. drivers kill about 20 pedestrians a day.
20 a day.
Yeah. And you're talking about cars causing roughly, 10% of global CO2 emissions. So the burrito paradox isn't just about inefficiency. It's about a massive societal design flaw.
Exactly. And that is the hook for today. We are doing a granular deep dive into Serve Robotics. Now, if you've walked around Los Angeles, West Hollywood, or even parts of Vancouver in the last few years, you've probably seen them, the little four-wheeled coolers rolling down the sidewalk.
The ones with the big eyes.
They have the big, expressive eyes.
Which we should probably note right off the bat is a very specific psychological design choice. They aren't just trying to be cute. They are trying to be non-threatening so you don't, kick them when they block your path.
Right. It's harder to be angry at a robot that's looking at you with puppy dog eyes. But today, the mission is to look past the cute eyes. Because it is Monday, January 26th, 2026. And looking at the stack of documents we have here, we've got earnings transcripts from late 2025, investor presentations, and some breaking news about a major acquisition. Serve Robotics has just hit a massive, massive milestone.
That's right. As of right now, Serve isn't just a pilot program anymore. It's not a science experiment. They have successfully deployed their 2,000th robot.
2,000 robot.
That is the magic number. And to really understand why that matters, you have to look at the velocity, the speed. At the start of 2025, so just a year ago, they had maybe 100 active robots.
100.
And half of those were engineering mules. They weren't even doing real commercial deliveries. They were just for testing.
So they spent nearly a decade spinning out of Uber and building the first 100, and then essentially 12 months building the next 1,900.
Precisely. That is the inflection point we are analyzing today. In the third quarter of 2025 alone, just one quarter, they shipped 380 units. That proves something critical to Wall Street and to their investors.
What's that?
They have solved the manufacturing bottleneck. They aren't hand-building these in a garage in San Francisco anymore. They are printing them at scale.
But here's the question. Why the rush? Why flood the streets with 2,000 robots right now? I mean, is the demand for burrito delivery really skyrocketing that fast?
It's not about the burritos.
Okay.
Not really. It's about the data.
Yeah.
The CEO, Kashani, he has been hammering this concept of the physical AI flywheel. And if you want to understand the bull case for this company, you really have to understand the flywheel.
I love a good flywheel concept. Break it down for us. How is this different from, say, a software flywheel?
Well, think about how something like ChatGPT learned. It scraped the internet. It read billions and billions of lines of text that already existed.
Right. It read the library.
You can't do that with physical robots. You can't scrape the physical world unless you are physically in it. An autonomy model, the brain of the robot, it needs what engineers call edge cases.
Edge cases.
Yes. So driving on a sunny, empty sidewalk is easy. A Roomba could almost do it. But what does the robot do when a construction crew changes the sidewalk layout overnight? Does it know what to do when a kid jumps out from behind a bush?
Or when there's a pile of snow blocking the curb cut. Or a dog is barking at it.
Exactly. These are things you can't really code for with simple if-then rules. The world is too messy.
So you need experience.
You need to experience them. And the flywheel works like this. You deploy more robots. Those robots drive more miles. Those miles generate more unique, weird, messy data. That data trains the neural networks. The AI gets smarter. The robot gets stuck less often.
Okay, that makes sense.
And when the robot gets stuck less often, the cost of operating it drops. When the cost drops, you can afford to deploy even more robots.
More robots, more miles, more data, better AI, lower cost, more robots.
That's the loop. So they're rushing to 2,000 units, essentially, to build a data moat.
A data moat.
That is the strategy. They view themselves as an AI platform for public spaces. If you are a competitor trying to start today, Serve is already millions of miles ahead of you in terms of knowing how to navigate a cracked sidewalk in Atlanta or a busy intersection in Dallas. That data is the real asset.
But let's talk about the money, because this flywheel, it relies on the economics actually working out, right? You mentioned the cost of operation dropping.
This is what they call their North Star economics. It's the goal for the whole company. Right now, if you order delivery via a human in a car, that traditional model we talked about, the actual cost of that last mile delivery is roughly $10.
Which is why my delivery fees are so high, and why the restaurant pays a commission, and why the driver still feels underpaid. It's just a really expensive system for everyone.
It's a broken system financially. Serve's management argues that with their Gen 3 robots and this physical AI flywheel, they can drive that cost down to $1.
From $10 to $1.
That's an order of magnitude reduction, a 90% drop. And if they hit that, they talk about a singularity moment.
The singularity?
Yeah, because at $1, the economics of what you can deliver completely change. You don't just deliver a $20 dinner. You can deliver a prescription from the pharmacy. You can deliver a single missing ingredient for a recipe. You can deliver a coffee.
It becomes a utility. It's like water or electricity. You just tap a button and the physical object moves to you cheaply.
That's the vision. That's the big, audacious goal. But, we have to be careful not to just accept the marketing pitch. That $1 target requires a lot of things to go right.
Especially around removing the human from the loop entirely.
Exactly. And we'll get into the risks later, because I know there are some bears out there who are skeptical, to say the least. But first, I want to talk about how they're making money today. Because when I looked at the earnings report from Q3 2025, I saw something that really surprised me. You're talking about the revenue mix.
Yes. Okay, so they have fleet services, which is the delivery fees from Uber Eats and DoorDash. That makes sense. But then there's this other chunk of money coming from advertising on the robots.
This is the aha moment for a lot of investors. The robot is a moving billboard.
It's literally rolling ad space.
Think about it. These robots operate in high-density urban areas. They're on sidewalks, moving at pedestrian speeds right at eye level. If you are a movie studio launching a new film or a beverage brand trying to reach a young demographic, that is prime out-of-home or, advertising real estate.
Okay, and the numbers back this up. In Q3 2025, their branding revenue surged 120% sequentially. I mean, quarter over quarter. That is massive growth.
And here's why that matters so much. Delivery margins are notoriously thin. Sometimes they're negative. You are competing with gig workers, you have maintenance, you have electricity. But advertising.
Advertising is almost pure profit.
It's incredibly high margin revenue. It's almost pure profit once the wrap is on the robot.
So the robot pays for itself partly just by existing and driving around with a logo on the side?
Exactly. It effectively subsidizes the delivery cost. It provides a financial cushion while they work on getting the autonomy cost down to that $1 target.
That is fascinating. It's like how newspapers used to work. The news was the product, but the ads paid the bills. Here, the burrito is the product, but the robot's exterior pays the bills.
It's a really smart diversification. But it's not the only one. We also need to look at the software and data services. In Q3 2025, they brought in, about $687,000 in total revenue? About $433,000 of that was fleet services. But $254,000 came from software.
And what exactly are they selling? They aren't selling the robots to consumers, right? People aren't buying these for their home.
No. They are licensing their autonomy stack. Their brain, basically. For example, they have a major partnership with Magna International. Magna is a Tier 1 automotive supplier. I mean, they build cars for companies like BMW and Toyota. They're huge. Serve is licensing its technology to Magna to help them build robots for industrial environments.
So this is the Intel inside play. Serve provides the brain, Magna provides the body for factory robots.
Correct. And it goes even further. There is a huge potential to sell data to cities. These robots are scanning the sidewalks constantly with LiDAR and cameras. They know where every pothole is. They know where tree roots are lifting the concrete. They know where construction is blocking ADA access.
That's actually very valuable data for a municipality.
It's incredibly valuable.
I hadn't thought of that. It's like a Google Street View car, but for the sidewalk. And it's updated every single day.
And much more granular.
Yeah.
So the business model is really a three-legged stool. You have the delivery fees, you have the advertising, and then the software data licensing. They are trying to move that software revenue from being lumpy, big one-time payments, to recurring revenue, which Wall Street loves.
Okay, so that's the business model. But to make any of this work, the technology has to be rock solid. You can't have robots driving into traffic or getting confused by a plastic bag. Let's talk about the hardware. They just rolled out the Gen 3 robot. Is this just a facelift or is it a real upgrade?
Oh, it's a complete hardware overhaul. This isn't just a software update. The Gen 3 robot is designed for manufacturing at scale. Remember Magna, the partner we just mentioned?
Yeah.
Magna is the contract manufacturer. So they're building these things on assembly lines, not hand-building them in a workshop.
And what are the specs? Why is Gen 3 better?
Okay, first, cost. It is 65% cheaper to build than the previous version. That is critical for that payback period we talked about. They want each robot to pay for itself in under 1 year.
65% cheaper. Wow.
Second, it has 5 times the compute power using the NVIDIA Jetson Orin platform.
5 times the compute power. Why does a delivery bot need that much brain power? It's not playing a video game.
Well, in a way it is. It's because of that physical AI shift. In the past, robots used a lot of heuristics, basically rule-based programming. If you see a red light, stop.
Yeah.
But the world is too messy for rules. The new approach uses end-to-end neural networks. You feed the camera input directly into the AI, and the AI outputs steering commands.
So it's learning to drive more like a human brain does.
Exactly. And that requires massive onboard processing power. You can't rely on the cloud for that. The latency would be too high. If a car is coming, you need to stop now, not in the 200 milliseconds it takes to ping a server and get a response.
That makes sense. It needs a supercomputer on board to react instantly.
Plus, the Gen 3 is faster. It has a top speed of 11 miles per hour.
That's a brisk run for a person.
It is. And speed equals money. If you can move at 11 mile per hour instead of 3 mile per hour, you can do more deliveries per hour. Your delivery radius expands. You can serve more customers from a single restaurant. It's a huge factor in the economics.
So cheaper to build, smarter brain, runs faster.
And a bigger battery, 67% more capacity. So it can stay out longer without needing to charge. It's a workhorse, designed for the real world.
But technology isn't just what you build in-house. Serve has been on a shopping spree. In late 2025, they acquired a company called Serve Robotics. What did they want with Serve?
Vayu was the brain acquisition. Vayu specialized in foundation AI models and simulation. See, one of the bottlenecks in training robots is that you have to wait for them to drive miles in the real world to learn.
You have to wait for something weird to happen.
Right. Vayu's tech allows Serve to use simulation more effectively, essentially training the robots in a video game world where they can run millions of scenarios overnight.
That speeds up the learning curve dramatically.
Absolutely. Instead of waiting for it to snow in Chicago to learn about snow, you can simulate snow conditions thousands of times and train the AI on that virtual data.
And then there's another one, Voices.
Voices is the eyes, specifically ultra-low latency video streaming. This addresses the teleoperation cost.
Okay, what's that?
Even with the best AI, sometimes a robot gets confused. Maybe a police officer is waving traffic through a red light. The robot doesn't understand that hand signal.
So it calls for help. It phones a friend.
It calls home, yeah. A human operator, a teleoperator, looks through the robot's cameras and says, okay, go ahead. But if the video feed has a 2-second delay, the human can't drive the robot safely. Voices technology minimizes that lag to almost nothing.
So one human can supervise more robots.
Many, many more robots, because they can resolve issues instantly and disconnect. It's all about leverage. They want one human overseeing 100 robots, not 10.
So Vayu makes the robot smarter, so it calls for help less often, and Voices makes the help more efficient when it is needed.
Exactly. It's a pincer movement on costs. They're attacking the problem from both sides.
Okay, speaking of snow in Chicago, let's talk about where these things are actually rolling. We know they started in LA, but looking at the map for early 2026, the footprint has expanded significantly.
It really has. They are now in Los Angeles, Miami, Dallas, Atlanta, specifically the Buckhead area, and the newest addition, Chicago.
Why Chicago? That seems like a nightmare for a robot. It's windy, it's snowy, the sidewalks are crowded. It's just a tough environment.
That is exactly why they went there.
For the challenge.
For the challenge and for the data. Remember the flywheel? They need edge cases. LA is great, but the weather is perfect almost every day. If you want to train a robust global AI, you need to master the windy city, navigating ice, snowbanks, people in thick coats. That is the data goldmine they are after.
So they are actively seeking out difficult environments to toughen up the AI.
Yes, and they are doing it with partners you'd recognize like Uber Eats, Shake Shack, and 7-Eleven. They are embedding themselves into the fabric of these cities.
But here is where it gets really interesting, and this is the news that just broke in January 2026. Serve Robotics acquired Diligent Robotics. Now, Diligent makes a robot called Moxie.
This is the pivot that I think most people are underestimating. This is huge.
Tell us about Moxie. This doesn't look like a cooler on wheels.
No, not at all. Moxie is a humanoid-ish robot. It's tall, it has a face on a screen, and most importantly, it has an arm manipulator. And it works inside hospitals.
Inside hospital. So we're leaving the sidewalk.
We're leaving the sidewalk and entering the hallway, the elevator, the secure ward. Moxie's job is to fetch things for nurses. It grabs medications, lab samples, lightweight supplies. It runs the errands so the nurses can stay with the patients.
And why did SERV buy them? Is there really money in fetching lab samples?
There is a lot of money. Think about the unit economics again. A sidewalk delivery gets you maybe a $2 fee, right? A Moxie robot deployed in a hospital generates between $200,000 and $400,000 in revenue annually.
Whoa, wait, say that again. $200,000 to $400,000 per robot per year.
Yes, because hospitals are facing a massive labor shortage. Nurses are burned out. They spend a huge amount of their time just walking to the pharmacy or the lab. Paying for a robot is significantly cheaper than paying a human runner, or, even worse, wasting a nurse's valuable time.
So this is high-value B2B enterprise revenue.
Absolutely. So Serve isn't trading high-volume, low-value burrito deliveries for lower-volume, high-value hospital logistics.
They're stacking them.
They're stacking them. This is the diversification strategy. Now they have the outdoor fleet and the indoor fleet. And the beauty is the physical AI stack. The brain can be shared. The navigation software that helps a robot avoid a pedestrian on a sidewalk can also help Moxie avoid a doctor in a hallway.
It's the same underlying problem, moving safely through a dynamic human environment.
Correct. And by acquiring Diligent, they essentially bought their way into the last 50 feet. The hardest part of delivery is often getting from the curb to the actual door or inside the building. Moxie gives them the tech to eventually handle that indoor piece.
This feels like a completely different company than the one that spun out of Uber a few years ago.
It is. It's maturing, but, and there's always a but.
Yep.
We have to talk about the financials.
Right.
Because you cannot grow this fast without burning a lot of cash.
Right. The move fast and break things model usually breaks the bank account first. So let's look at the balance sheet. They often use the phrase fortress balance sheet. Did they actually have a fortress?
They do have a significant pile of cash. As of the last report, they had around $210 million in cash and marketable securities.
$210 million sounds like a lot of money.
It is a lot, until you look at the burn rate.
Okay.
In Q3 2025, their revenue was roughly $687,000. But their cost of revenue, just the cost to perform those services, was over $5 million.
Ouch. So for every dollar they brought in, they spent about $7 just to do the work.
And that's before R&D, before sales and marketing, before administrative costs. Their net loss for that quarter was $33 million.
$33 million in one quarter. So that $210 million fortress, that gives them maybe, what, a year and a half of runway at this pace, maybe less?
Exactly. This is a venture scale bet. They are lighting cash on fire to build the fleet because they believe that once the fleet is large enough and the AI is good enough, the costs will plummet and the revenue will skyrocket.
It's the classic Silicon Valley playbook. Amazon did it, Uber did it, growth first, profits later.
But the risk is much higher here because hardware is hard. You can't just fix a bug in the code. You have to fix a broken axle in the middle of a Chicago winter.
What is the guidance saying? What did they expect to happen in 2026?
They projected over $2.5 million in revenue for full year 2025. But for 2026, the consensus estimates are hoping for a massive jump, something like a 10x increase to around $35 million.
A 10x revenue growth in 1 year? That's ambitious.
It's what they have to hit. And they are eventually eyeing a $60 to $80 million run rate. If they miss that growth curve, investors are going to get very nervous very fast.
So we have the bull case. They are the leaders in physical AI. They have a diversified business model with ads in hospitals, and they are scaling fast. Now, I want to play devil's advocate. Let's look at the bear case. What are the critical risks here?
There are a few red flags that we really need to be honest about. The first one is utilization lag.
What does that mean in this context?
It means the difference between having a robot deployed and having a robot active. In Q3 2025, they had a large fleet deployed, but the daily active robots number was only 312.
Wait, so they have 2,000 robots sitting in warehouses or charging stations, but only about 300 of them are actually out working on any given day.
That was the data from Q3. Now, obviously, as they scale into 2026, that number needs to come way up, but it highlights a risk. It's no good having 2,000 robots if there isn't enough demand from Uber Eats or DoorDash to keep them busy.
Right. If the robots are sitting idle, they aren't generating delivery fees, and they aren't generating ad impressions.
They're just depreciating assets gathering dust. It's a huge problem. They need to turn deployed into utilized. The second big risk is customer concentration.
I noticed this too in the report. 70% of their revenue comes from just 2 customers.
That's right. Likely Uber, because of the legacy relationship from the spin-out, and one other major partner. That is a dangerous position to be in. If Uber decides tomorrow that they want to build their own robots or partner with a different company, Serve loses a massive chunk of their revenue overnight.
They are at the mercy of the giants.
They are. The advertising business helps diversify that, and the Moxie acquisition helps a lot. But right now, they are still very, very dependent on the food delivery apps.
And what about the shareholders? You mentioned the cash burn. How does that affect them?
Dilution. That is the dirty word for existing shareholders. To raise that $210 million fortress, they had to sell a lot of stock. They did a $100 million raise in October 2025. Every time they do that, they sell new shares, and the existing shares are worth a little less of the company.
Your slice of the pie gets smaller.
Exactly. So if you are an investor, you have to be comfortable with your slice getting smaller, betting that the pie itself will get infinitely bigger. And if they continue to burn $33 million a quarter, they will need to raise money again soon.
Which leads to the last risk, I assume.
The land grab risk.
Explain that.
A land grab strategy means you rush to take territory, cities, sidewalks, market share before the economics are fully proven. Serve is betting the company on the idea that the physical AI flywheel will lower costs to $1. But what if it doesn't? What if it bottoms out at $4 or $5?
And the business model doesn't work. The singularity never happens.
Then they have 2,000 robots that cost more to run than they make. They are betting the company on the technology improving at a specific rate. If the tech stalls or plateaus, the company stalls.
It's a race against the runway. Can they solve the autonomy puzzle before the bank account hits 0?
That is the fundamental question for this company in 2026.
Okay, so let's zoom out. We've covered the tech, the money, the risks. Where does this leave us? What's the final verdict?
I think the summary is this. Serve Robotics has successfully transformed. They are no longer a cute science experiment. They are a scalable utility operator. They have 2,000 robots. They have diversified into high-margin advertising and high-revenue healthcare logistics.
And they are betting everything on that physical AI vision.
Yes, they are betting that they can rewrite the operating system of the city.
That's a bold phrase, rewriting the operating system of the city.
But think about it. For 100 years, our cities have been designed around the automobile. Wide lanes, parking lots, traffic lights. Serve is suggesting a new layer of infrastructure, a layer of small, autonomous agents that move goods silently and efficiently on the sidewalk. If they succeed, it changes how we design cities.
We might need fewer parking spots. We might need wider sidewalks.
It's a massive shift, a fundamental change.
It really is. You know, we started this episode talking about the burrito paradox, and it seems like Serve has a solution for that. But with the value and diligent acquisitions, I'm starting to think the burrito is just the Trojan horse.
That is exactly right. If we connect this to the bigger picture, we are all focused on the robots delivering food. But look at what they're building. They have the brain from the Vayu acquisition. They have the eyes from the Voices acquisition. They have the body from the Magna partnership. And now they have the hands with Moxie.
They're building the components of a universal robot.
Serve is building a universal autonomy platform, a brain that can pilot any moving machine. Today, it's a cooler on a sidewalk. Tomorrow, it's a hospital assistant. The day after, maybe it's a forklift. Maybe it's a security bot. Maybe it's something we haven't even thought of yet.
So the end game might not be delivery at all.
The end game might be becoming the Microsoft Windows of physical automation, the software that runs everything that moves in the physical world.
And if that happens, that little robot on the sidewalk isn't just a burrito delivery bot. It's the first glimpse of a completely new automated world.
Precisely. And that is why, despite all the risks and the cash burn, this is a company everyone should be watching very, very closely in 2026.
Well, on that note, we are going to wrap up this deep dive. Whether you are an investor, a tech enthusiast, or just someone waiting for a burrito, there is a lot to think about here.
Absolutely. It's going to be a fascinating year for them.
Thanks for listening. We'll catch you on the next deep dive.